Thank you very much, Mark. Next up is Todd Petzel, who's the Chief Investment Officer for Offit Capital Advisors and member of their investment committee. And before that, Todd was a founding partner at Azimuth Asset Management, which some of you no doubt know about, a fund of hedge funds. And before that, he was Chief Investment Officer of the Common Fund. He, in an earlier incarnation, was chief economist as a Chicago native, we call the Merc, the Chicago Mercantile Exchange. And within that, interestingly, was, I guess prior to that, was chief economist at the Coffee, Sugar, and Cocoa Exchange in New York, which is often a very interesting leading indicator, which maybe Todd can tell us a little bit about, among other remarks. Todd?
Thank you. If you've seen the movie Trading Places, it was shot at my old job. I was asked to give the investor perspective on this topic, and I wasn't sure what I could tell you that you don't already see every day in the headlines. Market volatility, high correlations, all driven by macroeconomic events. Today on the front page you have European debt concerns and then the potential banking crisis. But on page 2 and page 3, there's the US story that's just waiting to move up to the front page. Every day we have risk on or risk off trades. We don't seem to be trading on fundamentals. It's a very tough environment for investors. You all know that. What I wanted to talk about are a couple specific ideas that I think are problems, and hopefully we can get to a solution. The first thing is that I've seen a sea change in US investors in the last 10 or 15 years. Years ago, people were US-centric in their orientation. They probably made their wealth in the United States. They had a strong attachment to our fundamental growth story. And it was very hard to get them to diversify their portfolios internationally, especially in emerging markets. Those of you who have EM investments in September know that they can be risky. Today, it's just the reverse. We don't have to urge them very much at all because they're not optimistic. They don't have the confidence that Mark was talking about in terms of the US story going forward. And they do see growth in China and Brazil and other places. So ironically, 15 years ago, a Brazilian investor would be looking to get all their money out of Brazil for safety and growth. Today, they're looking at home, and we're doing the reverse. That's not actually a very good story, if you think about it. The other piece is the problem that we're having with the Federal Reserve policy of zero interest rates. Now, the CPI just printed a couple, last week I think it was, 3.9% year-over-year CPI. With zero interest rates for treasuries and most safe securities, that's a very serious negative number on real returns. Professors Reinhardt and Rogoff have dubbed this, a nice term, financial repression, the slow extraction of wealth from the population to subsidize the behavior of the government. I had a client last week who described it a little bit more colorfully. He said the zero interest rate policy is like getting kicked to death by a rabbit. Now, think about it. It's not very dramatic. It's not very sudden. But the end is just as final. It's an important concept. Why is the Fed doing this? Well, they say they want to promote investment and growth. They want to have low interest rates. The HARP program, which was mentioned, is an example. If interest rates are low and people can take advantage of it, money will be put into their pocket. An analysis that I saw in the paper on Monday said that if every mortgage that was eligible for HARP got refinanced, it would put $25 billion into the hands of those people. A lady was quoted in the Wall Street Journal today saying, if I could refinance my mortgage, I'd buy a new carpet. So this is obviously what we want people to do. Now, I want you to look at it from a different community, the one that Mark didn't address. These are people who don't have debt. They've been saving very carefully all their life. They may have paid off their mortgage. Their only goal in life is to get through to the end without depleting their savings. They rely on fixed income. They rely on those CD rates. Okay. My parents, 86 years old, fall into this category, are not wealthy people. Suppose interest rates were to move up by 2.5%. I picked that number because that would take interest rates up to close to historical normal levels. The interest on treasuries, agencies, and munis, raising it up 2.5%, would generate $350 billion of income for the people who have lent that money. That doesn't count corporate debt. It doesn't count savings accounts. If you put that pile in there, we're talking multiple hundreds of billions of dollars more. Now, I don't know what the marginal propensity to consume out of that is. People who are critical of this kind of policy would say, that money won't be spent, it'll be saved. But suppose it's 50%. Suppose we save 50%, spend 50%. We're talking about an impact on consumption that is 10 times larger than anything the HARP program could possibly generate. Zero interest rates, financial repression. So why is the Fed doing it? Well, the first reason I think they're doing it is because they want to get zero cost funds in the hand of banks who can turn around and make a little money on it, or perhaps add it to the $1.5 trillion in excess reserves at the Fed today that are getting paid 25 basis points. That is part of a healing process. The Fed should probably be doing this, but it comes at a cost. The other reason they're doing it is that it helps the Treasury. Obviously, paying 3% on 30-year bonds is a lot more palatable to the budget than paying 4 or 5%. So they're getting some help there. But that can't solve the problem. The goal here should not be trying to make it easier to carry a heavy load. The goal here should be to make the debt load smaller. And I'm not going to repeat all of the things that we're already talking about in terms of the CED outline. I endorse all of those, and I think everybody, most of the people in the room do. So I'm going to make a prediction here. If the super committee could possibly come out of their deliberations with something that is both meaningful and credible, I think the investment community would embrace this wholeheartedly. It would build confidence. The stock market would go up. We might see an era where we will have positive real rates of return again. And I can guarantee you, in those circumstances, jobs will follow. So that's the goal of what we're all trying to accomplish here from an investor perspective, is to get back on a confident path, one where we have hope in our country. Unfortunately, until we get that kind of accomplishment under our belt, I think we're going to kind of be in the soup, so to speak, and hope it's not rabbit soup, both here and in Europe, until we are looking for more investment opportunities, not onshore, but offshore, and transporting our future out instead of looking in and building. Thank you.